Welcome to Trader TV. I'm Dan Barnes. Last year saw severe disruption in the US Treasuries market, especially in March during the sell-off, and trading volumes have not quite recovered ever since. With me today is Kevin McPartland, Head of Market Structure and Technology Research at Greenwich Associates. We're going to be talking about the lessons learned from 2020 and also how trading activity has looked over December and the New Year period. Kevin, welcome to the show.
Thanks for having me, Dan.
So you guys have done some great analysis on what happened last year. Could you tell us what the key takeaways are from your perspective?
So we saw some incredible records back in March and really in late February. Late February, we saw the futures market volumes really spike to records. In March, we saw Treasury volumes spike to records. We had a number of days where over $1 trillion in Treasuries traded in a single day, which is just incredible. The previous record was about 800 billion a day. And the average sort of over the previous year had only been about sort of between 500 and 600 a day. So really incredible activity. But what I found particularly interesting now that we've been able to analyze the entire year's worth of activity is Treasury trading average daily volumes in 2020 were up only 2% from 2019.
Wow.
Shows you how calm the year became once the Fed stepped in. The same is true for volatility measures in the Treasury market. So looking at the ICE Bank of America Move Index, which measures rate volatility, that was only up 6% year over year, right? So it was really incredible how calm in the end the full year was. And a lot of that goes back to government intervention.
We've seen data from some of the electronic trading platforms in the dealer to client area, which suggests that towards the end of the year, they were still seeing volumes significantly up on 2019. Could you break down where you saw volumes up and down and what potentially that might mean?
Yeah, so one of the more interesting things that seems like it has stuck with us still is that order book volumes, right? So you can think about the major platforms now are BrokerTec, NASDAQ, Fenix. As a collective, those volumes were down relative to the total market, whereas the dealer client activity, mostly in the RFQ markets, which is mostly TradeWeb and Bloomberg, were up as a percentage of the total market. And that trend, which we wondered back in the spring and in the early summer if that was something temporary that would eventually sort of fade, it has still stuck with us. Obviously, we're still not in normal times. We could revert back to the normal, but it does seem that the use of aggregated price streams, right, coming from dealers, and then also internalization of trades at the dealers could be having now an impact on the order book market. And then the other piece is futures volumes relative to the cash market are also down and have been down. There's been definitely with some recovery in the fourth quarter, but we wonder if some of those cash to Treasury futures arbitrage trades that went completely wacky in the spring, some of the smaller firms that were in those strategies backed away. And so the diminished amount of activity with that trade has kept those volumes down, both in the order books and in the futures market.
And so typically that's going to be in the interdealer market. And so, as you mentioned, banks offsetting their risk either by crossing internally or perhaps trading into the dealer to client market more. Does that have any potential implications for the dealer to client market, or do you think the banks are sort of absorbing that?
I think the clients have good liquidity. They have access to liquidity. They feel that transparency in the market is quite good, in fact.
Yeah.
They already were in a good place. This potentially could have benefited those clients over time. Really what the order book market and the futures market come down to is risk management for the dealers. Right. Clearly, the dealers have not stopped risk managing their books. It seems as if maybe they've just found some new ways that are maybe cheaper or quicker to do that than they had been doing in the past.
And then the other thing we've seen about the interdealer markets, of course, is the potential application of Reg ATS to the central limit order book Treasury trading platforms, which would be interdealer largely. Obviously, that's still to play out. But again, that could create either more transparency or impact the markets as well, do you think?
Yeah, I think one thing it points to, I said volumes have been down in those markets, but we should remember how important those markets still are. They're still very robust. They still are where benchmark prices are generally set. And that's exactly why the SEC is looking at increased oversight in those marketplaces because of their importance to the overall Treasury market, and one could argue to the capital markets as a whole. I think the wild card in those regulations now is we have a new administration in Washington. We're going to have a new chairman of the SEC, Gary Gensler. Whether or not fixed income proposals and changes will be high on the priority list. It seems they might spend more time focused on consumer issues. For better or worse, fixed income market structure has always been a little bit second priority, it seems, to the SEC, who does tend to be more focused on equity markets. So time will tell, but it's definitely an interesting development and something we're going to watch closely.
How's trading activity in the rates markets looked in sort of December and then across the New Year period?
Transaction volumes in January is up a bit, which is great. I think we're averaging a little over 600 billion a day. I think sort of the new administration, the talk of fiscal stimulus, and again, I'm not an economist, but we see 10-year yields are tracking up. So it's sort of the sentiment is positive. There is more activity. It should be an interesting year. Hopefully for everybody, it can only be a better year, but there definitely is a lot of uncertainty, although uncertainty often leads to more activity. So we definitely could expect some of that.
Do you have any views on the rates markets in Europe at all?
Yeah, so that's something we're digging into a little bit more now. Obviously, MiFID II sort of well understood at this point. It does seem that there's been growth in activity there. Government bond markets in Europe, it's a very different dynamic than in the States, where it's really just U.S. Treasuries. It's effectively one country's government bonds as opposed to many country government bonds. Brexit could be interesting there. Time will tell. We're also doing some looking to understand. There have been some technology innovations that have worked in the US or have worked well in Europe that maybe haven't been picked up in the other market. I think in the end, in both the US, Europe, the UK, there really is a push for better efficiency, better workflows, more automation in the marketplace, not just the execution piece, but full end to end. And that's something that I think will be a big focus for the buy side and the sell side through 2021.
That's been great. Kevin, thanks so much.
All right. It was a pleasure talking with you, Dan. Thanks.
I'd like to thank Kevin for his insights and, of course, you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net or etftv.net.